The following is not financial advice and is purely intended for entertainment purposes only. A self-proclaimed zombie company whose original focus was on software and data intelligence back in 2020, MicroStrategy was sitting on $500 million in cash, losing value to inflation and fully aware that the Fed was about to print enormous amounts of stimulus money for COVID. So they're looking for somewhere safe to protect their capital. And after exhausting every other option, Michael Saylor finds the hardest money on the planet, Bitcoin. Today, Strategy is sitting on 629,000 Bitcoin worth over $72 billion. This is 11 times more Bitcoin than the next largest company that holds Bitcoin on their balance sheet, a literal order of magnitude larger. As of the current Bitcoin valuation of around $120,000, the next largest company would have to purchase $65 billion worth of Bitcoin just to catch up to them. The only problem with that is that a purchase that big would move the market and push the value of Strategy's Bitcoin holdings even higher, making it even harder for someone to catch up to them. There's only a handful of companies with that much available capital to do such a thing. It's essentially just the Magnificent Seven, and they're not going to do this because they're already incredibly successful with their current operating plans. At the moment, there's no incentive for them to pivot into a Bitcoin treasury strategy. Ultimately, this means that Strategy likely can't be caught. Strategy has gone from a $1 billion market cap in 2020 to a $120 billion market cap in just 5 years. Let's take a look and compare strategies to some of the largest companies in the world. This table shows 4 key metrics: the amount of Bitcoin held on the balance sheet, the market cap, which is the total value of all outstanding shares, the mNav, or multiple to net asset value, which measures how much the company is valued above or below the raw value of its assets, and finally, the price to earnings ratio, or PE ratio, a traditional stock market metric that compares a company's market value to its actual earnings, helping investors gauge how expensive or profitable a company appears. While mNav and PE ratios are not directly comparable, they can give you an idea of how much premium investors are willing to pay for a stock based on how well they think it will perform in the future. Here we can see that Strategy has 629,000 Bitcoin and a market cap of $114 billion, giving them an mNav of 1.77, which is the premium that you're paying for each share relative to how much Bitcoin the company owns. But take a look at the PE ratios for the Mag 7 stocks. They're quite a bit higher, with Nvidia reaching as high as 55.79x, meaning that you're paying $55.79 for each dollar that Nvidia earns. Nvidia is clearly a very valuable company and deserves a high PE ratio. The point that I'm trying to make here is that all of these companies will eventually bend the knee to Bitcoin and start accumulating Bitcoin. Every company in the world will eventually be a Bitcoin company, the same way that every company is now online. So what will happen to Strategy's market cap and mNav when the Mag 7 decides it's finally time to pile into Bitcoin? This could be a long way off, and there's no guarantee of anything, but it's an interesting thought. When someone offers you a mortgage for a house, they will look at your risk profile. What assets do you own? What liabilities do you have? And they'll ask, what is the likelihood that you'll be able to pay back this loan? If they think that you can pay back the loan, they'll give you the loan and you go and buy your house. Strategy is holding $72 billion of Bitcoin capital and has only $8 billion of debt and $3 billion of preferred equity paying out dividends, a total of $11 billion of debt, which means that they have a 16% leverage ratio. This is an incredibly strong financial company, which makes it easy to assess whether someone would want to offer them a loan. So you might ask, why would someone buy MSTR, Strategy's common stock, instead of just buying Bitcoin? When you buy Bitcoin and hold it in a wallet, preferably cold storage, you actually own and control that asset. It's your property. When you own MSTR, Strategy's common stock, you own equity in Strategy the company. And when you value an equity, you look at an expectation of future cash flows. However, Strategy's Bitcoin treasury play can be more closely compared to an insurance company. When you value an insurance company, you value their financial strength and their ability to leverage their balance sheet. These are two different valuation models that are colliding, creating an entirely new framework on how to value these Bitcoin treasury companies. So going back to the question of why somebody would buy Strategy instead of buying Bitcoin, it's important to understand that these are two completely different things. Bitcoin is hard money, plain and simple. MSTR is equity, which is an expectation of future growth of the company based on their active operations in leveraging their Bitcoin balance sheet and issuing various different financial products like their preferred stocks, which we'll get into later. However, the MSTR stock trades at a multiple to the value of the Bitcoin on their balance sheet, and this is called an mNav, multiple to net asset value. There are two comparisons I'd like to make to give the mNav metric some context. One is that Bitcoin itself trades at a premium to its production value, often between 1x to 8x more than the cost of producing Bitcoin through mining. For example, if on average it cost a Bitcoin miner $50,000 in energy and compute to mine a single Bitcoin, if Bitcoin's price falls below this level, miners can make more money by selling the energy that they're producing back to the grid and just buying the Bitcoin, as it's more cost effective. And if Bitcoin is trading at a price higher than this, then when you buy Bitcoin, you are paying a premium to own that Bitcoin and not have the costs associated with setting up a Bitcoin mining operation. Another is that traditional companies' stocks trade at a premium to their earnings. This is called the price to earnings ratio. For example, Olive Garden trades at a 32x PE ratio, meaning that for every $1 that Olive Garden earns in revenue, you are paying $32 of extra premium to own that stock. Markets are forward-looking, so this premium is justified by the expectation that the company will grow and increase their revenue in the future. Strategy's stock MSTR trades at a premium to the value of their Bitcoin holdings, the mNav, and it's on average around 1.8x higher. So for every $1 of Bitcoin that the company holds, you pay $1.80 for MicroStrategy. This is because markets are forward-looking. There's an expectation that Strategy will actively leverage their balance sheet and financial products to earn more Bitcoin in the future, faster than you would be able to accumulate it if you just bought the Bitcoin itself and kept it in cold storage. Strategy is monetizing the Bitcoin in their balance sheet as collateral. They're taking $72 billion worth of Bitcoin and transforming it into various financial products with different risk profiles, all collateralized with Bitcoin. Bitcoin is an inherently volatile asset. Its price fluctuates wildly even on a calm day. Strategy is removing the volatility from Bitcoin and controlling it by issuing these new financial products. They have reduced upside and reduced downside, making them more attractive to more risk-averse investors, as they still perform well but have downside protection and are relatively safer due to their position on the capital stack. This extra volatility that has been removed is stuffed back into MSTR, the common stock, providing higher volatility than Bitcoin, higher returns, and higher downside in a dip or correction as well. So what are the risks with this? If Bitcoin's price falls enough, then Strategy would be forced to sell their Bitcoin, which may force them to pay off the different tiers of equity holders in their capital stack, starting from the least risky preferred stocks at the top of their stack, who get paid out first in the event of a liquidation event, and working down the stack to the riskier MSTR common stock, who get paid out last in the event of liquidation. But in order for this to happen, Bitcoin would have to fall to around $15,000 to $20,000 and remain there for roughly 5 years. And with a trend in adoption, that seems highly unlikely. So what is the total addressable market for a Strategy and for Bitcoin-backed credit products? How high can this thing go? Well, Strategy's common stock and preferred products are competing for a store of value similarly to Bitcoin. They just have different levels of risk and volatility. The total addressable market for store of value is effectively half of the entire balance sheet of the world. That's a $500 trillion total addressable market. The fixed income markets are $300 trillion, real estate is $330 trillion, money is $120 trillion, equity is $115, gold is $22. That's not to say that Strategy will capture all of this, but as of mid-2025, Strategy is a $100 billion shark in a $1,000 trillion swimming pool, and all of the other creatures in the pool are harmless fish, dolphins, and whales about to be eaten by the biggest, baddest great white since Jaws or the Meg. To fully understand Strategy's approach, we need to look at the three financial products they've created: STRK, STRF, and STRD. These are all types of preferred stock, which means that they sit above common shares like MSTR in the capital stack. Each one of them is designed with different levels of risk, return, and exposure to Bitcoin. STRF, Strife. This is the safest, most conservative of the three, a perpetual preferred stock, meaning it pays a fixed dividend forever. Here's how it works. It pays $10 per share in cash dividends every year indefinitely. When first issued at $80 per share, that was a 12.5% yield. As the price rose due to demand, the yield dropped closer to 9.5%. There's no exposure to Bitcoin's price, just steady income. Why this matters? It's designed for conservative investors, pensions, insurers, or income-focused funds who want yield but can't touch Bitcoin or high volatility assets. Backed by Strategy's Bitcoin holdings, but shields the buyer from Bitcoin's volatility. Its capital stack position is the highest priority after debt. It gets paid first if the company ever goes bust. STRK, or Strike. What this is a hybrid product that offers both dividends and Bitcoin-linked upside. How it works is it pays $8 per share per year indefinitely. 10 Strike shares can be converted into one MSTR share, giving it upside if MSTR ever rises. If MSTR trades above $1,000, Strike becomes more valuable thanks to the convertibility. Still lower volatility than MSTR itself due to the steady dividend. Why this matters is STRK appeals to investors who want exposure to Bitcoin and MicroStrategy's growth, but with less risk than buying the common stock outright. It's like holding a long-term call option with a safety net. Its capital stack position is middle tier, it's safer than the common stock, riskier than STRF, paid out after STRF in a liquidation. STRD, or Stride, this is the riskiest of the three, designed for higher returns in exchange for lower protection. It also pays a $10 annual dividend, but unlike STRF, the dividend is non-cumulative. If Strategy skips a payment, you don't get it back. You're closer to the bottom of the capital stack, meaning that higher risk in worst-case scenarios. It may trade at a discount or offer a higher yield, depending on the market demand. STRD is for investors willing to take more risk in exchange for the possibility of higher returns. It helps Strategy raise capital more aggressively by offering less protection and more upside potential to those willing to stomach it. Lowest of the three preferreds in the capital stack, paid out before common shareholders in liquidation. These three offerings let Strategy cater to a wide range of investors. STRF for safety and yield for risk-averse investors, STRK for yield plus equity upside, which is balance, and STRD for high-risk, high-reward bets and speculators. And the beauty of it is that all of them are backed by the same thing, Bitcoin on Strategy's balance sheet. By offering these products, Strategy is essentially removing the volatility from Bitcoin, slicing it into different risk levels, and selling it to investors in formats that they understand. So why does all of this matter? Because Strategy isn't just stacking Bitcoin, they're building pipes that connect Bitcoin to the deepest pools of capital on Earth. Most people still can't or won't buy and hold Bitcoin directly. It's unfamiliar, intimidating, and outside of their existing financial framework. As Jeff Walton puts it, they're like a fisherman in the ocean, casting hooks down to different depths of the capital markets. Whether you're a pension fund at the surface or a high-yield speculator deep below, Strategy has created a product to catch you. They've transformed Bitcoin from a volatile internet asset into a structured, yield-bearing instrument that institutions can understand and buy. That's never been done before. And the more capital they receive from selling these products, the more Bitcoin they acquire. The more Bitcoin they acquire, the more collateral, the stronger their position comes. It's a reflexive loop, one that's helping raise the floor for Bitcoin itself. This isn't the financialization of Bitcoin, it's the Bitcoinization of finance. If you have any questions or want me to cover any topics, please drop a comment. Remember to like and subscribe. Thank you for watching. I'll catch you in the next one.